The U.S. stock market is currently closed for the weekend, and looking back at the most recent trading session on Thursday, June 18, 2026, Nokia OYJ, trading under the ticker symbol NOK on the New York Stock Exchange, finished the day at $13.49. This represented an intraday drop of 2.46%, with the stock sliding 34 cents over the course of the session, from an opening price of $14 flat. Trading volume was incredibly heavy, clocking in at over 126 million shares moving through the market, which towers over historical averages for this particular asset. If you look at the immediate after-hours action, the stock managed a slight dead cat bounce, or technical tick upward, of about 11 cents, putting the extended session indicator at $13.60. This recent cooling down comes after a blistering multi-month run that caught almost the entire retail trading community completely off guard, especially those monitoring their portfolios via mobile apps or setting up automated asset allocations on various modern brokerages. The immediate reaction for anyone glancing at their individual brokerage screen might be to assume that this 2.5% dip is just a routine correction for a sleepy European telecom stock that briefly got hot. But the underlying reality completely upends that expectation. While the general market narrative still treats this company as an old-school provider of hardware components for mobile carrier networks, a massive institutional transition is taking place underneath the surface that normal retail investors are completely misinterpreting. A major chip designer recently put down a massive $1 billion equity stake in this firm, completely restructuring the technical thesis for the stock. This transition has suddenly forced the equity into direct conversation with high-flying infrastructure names, causing retail platforms to experience a massive surge in volume for this single ticker, as investors try to figure out whether they are buying a legacy networking business or a modern data center connectivity play. The common ground among most market observers is that this company is a relic of previous tech cycles, a business that was largely left behind while larger mega-cap equities grabbed all the headlines. People look at the historical charts and remember the hardware mistakes from decades ago, assuming the stock is a permanent value trap with minimal upside. The contrarian reality is that the company has quietly positioned itself at the absolute center of next-generation infrastructure, specifically at the intersection of mobile access networks and computing power at the edge. The broader investing public has been completely focused on chasing extreme valuations in hardware leaders, while ignoring the physical glass fibers and radio access networks that actually transport that computing power to the physical world. This massive disconnect between what the market thinks the company does and what its new financial backers are building is creating one of the most volatile valuation reassessments we have seen in the tech space this year. When you look at recent trading activity, the volatility has been intense, driven by a sharp contrast between short-term macro pressures and aggressive institutional accumulation. The stock recently hit a 52-week high of $17.45 before pulling back to its current $13 range. This represents a massive surge from its 52-week low of just $4 flat, a move that was heavily accelerated by massive block trades and significant options activity. SIBO data from the past 48 hours shows highly mixed option sentiment, with a heavy concentration of put options protecting downside positions against a lighter but highly aggressive call volume near the $15 strike price. This tug-of-war is happening because institutional funds are aggressively accumulating shares, while short-term retail traders who bought during the recent momentum spike are starting to take profits on their positions. If you look at the broader sector momentum, traditional telecommunication spending has been soft, which is why the legacy part of the business has faced headwinds. High interest rates throughout the past couple of years have forced major telecom carriers to scale back their capital expenditures, directly impacting traditional hardware orders. Yet despite these macroeconomic pressures, the stock has managed to deliver massive outperformance over a one-year window, leaving standard index benchmarks far behind. This outperformance is driven entirely by capital flowing into the company's optical networking division, which saw double-digit growth in recent quarters as cloud hyperscalers expanded their network footprints. Large institutional players are moving their capital out of speculative software plays and rotating into these tangible hardware assets that possess stable cash flows and massive strategic backstops. Comment below how many shares of Nokia you currently hold in your portfolio and whether you are buying more at this current $13 level or waiting for a deeper pullback. Understanding how this stock fits into a modern portfolio requires looking at how retail investors are managing their assets across different platforms today. Many self-directed investors who focus on self-investing are utilizing tools like Schwab Intelligent Portfolios or various online investing sites to find stability, often overlooking individual international equities in favor of broader market funds. When people look for investment help or want to invest online, they typically lean toward familiar names, placing orders for Tesla stock, Apple stock, or Nvidia stock through a Fidelity trading platform or a Robinhood app.
But those who specialize in active online investing and maintain a specialized individual brokerage account are starting to notice the massive shift in corporate positioning that this specific Finnish firm is executing. Platforms that support detailed technical charting, such as the Interactive Brokers platform, have seen a significant surge in retail options volume for this ticker, showing that sophisticated traders are actively betting on a major breakout past the recent resistance levels. To really grasp the tension between the market expectation and the actual reality of this business, it helps to understand exactly what the company does today versus what it did during its historical peak. For most of the past decade, the business model was tied entirely to designing and selling radio access networking equipment, routers, and switches to massive telecom providers globally. It operated in a highly cyclical industry with razor-thin margins, constantly battling global competitors for expensive 5G contracts while dealing with massive restructuring costs and corporate layoffs. The old report card showed flat revenue growth and thin net income margins, which explains why the asset traded as a low multiple stock for so long. But the entire model transformed through strategic corporate actions, specifically a massive corporate acquisition of a major American optical networking company that closed early last year, combined with a total executive shakeup that brought in veteran data center leadership. Today, the core business model is being deliberately tilted toward data center connectivity and automated edge architecture. Instead of just building antennas for cellular towers, the firm is integrating advanced graphics processing units directly into its radio access software. This allows mobile operators to process massive computing tasks locally at the network edge, rather than routing everything back to a centralized server, which drastically reduces latency and saves immense amounts of bandwidth. The company makes money through high-margin software licenses and specialized optical transport hardware that hyperscalers need to connect their data centers. This fundamental shift from low-margin telecom hardware to high-margin infrastructure software is the exact reason why the stock's price-to-earnings ratio has ballooned to a trailing multiple of over 80, a figure that looks incredibly overvalued on a traditional telecom spreadsheet, but makes perfect sense to growth investors who view it through an infrastructure framework. Looking at the future outlook, several distinct scenarios could play out over the coming quarters, each deeply tied to the expectation versus reality dynamic. The most bullish scenario involves the company securing massive, multi-year design wins with major cloud hyperscalers who need their high-bandwidth optical systems to handle expanding network loads. If these contracts manifest in the upcoming corporate earnings reports, the current 80 times multiple will rapidly compress as net income surges, potentially re-rating the stock towards its previous highs near $17. Investors who manage their wealth through Fidelity investments, looking closely at Fidelity mutual funds or building specific custom baskets of Fidelity ETFs, might find that active managers are increasing their weightings in this name to capture that specific enterprise spending lift. Those executing short-term strategies through Robinhood stock trading or utilizing Robinhood fractional shares will likely ride the immediate momentum if the company beats its margin targets. However, the bear case is equally compelling and shouldn't be ignored by anyone engaged in serious online investing. The current valuation leaves absolutely zero room for error, and any delay in contract execution or a broader slowdown in corporate infrastructure spending could cause severe damage to the share price. If the expected infrastructure spend slows down due to persistent macroeconomic headwinds or corporate budget cuts, the reality will fall short of the current narrative and the stock could easily slide back towards its support levels in the single digits. Furthermore, global competition remains fierce, and if rival hardware manufacturers begin discounting their optical equipment to win market share, the company's projected operating profits for the next 2 years could flatten significantly. Traders managing their accounts via SoFi Active Investing or setting up automated allocations through a SoFi robo-advisor need to be aware that this is no longer a slow-moving defensive dividend stock. It is transformed into a high-beta asset that will swing violently based on capital expenditure reports from major tech companies. For those tracking these movements through Interactive Brokers stock trading, paying close attention to Interactive Brokers fees and margin requirements is essential as the stock tests its current technical boundaries. The underlying options pricing suggests that the market is preparing for an extended period of consolidation around this $13 range before the next major catalyst occurs. Whether you are using Robinhood crypto and cash management features to maintain liquidity, balancing your long-term retirement goals inside Fidelity IRAs, or executing complex spreads via the Robinhood Investments interface, understanding the core thesis of this stock is about recognizing that you are betting on a complete corporate identity shift. The company is actively trying to escape the low multiple graveyard of traditional telecommunications and enter the high multiple environment of computing infrastructure, and that transition is never a smooth line. In summary, the central insight driving this entire stock narrative is the intense friction between a lingering legacy reputation and an aggressive institutional repositioning. The market expectation is that this company is a slow, cyclical utility supplier, but the reality is a heavily backed infrastructure play that is actively integrating deep computing power into the global network grid. The recent pullback to $13.49 highlights the short-term exhaustion of momentum buyers, but the massive trading volume and institutional backing indicate that the long-term thesis is far from over. As you monitor your portfolios across various investing sites or adjust your individual brokerage accounts, keeping an eye on this gap between public perception and physical enterprise reality will be the key to anticipating where this equity moves next. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.